Recession is a pretty scary word, I think you'll agree. But how bad is it for investing? Will it kick you to the curb, or is it a potential opportunity to make a vast amount of wealth? The Bank of England has now predicted a UK-based recession during Q4 of 2022, with a potential contraction of 1% of our GDP. Oil and gas prices have already skyrocketed, meaning that energy bills are out of control, and that is only predicted to get worse during the end of the year and into early next year.
There's no sugarcoating it. Energy bills this winter are going to be very grim indeed. And what's been particularly frightening this week is just how quickly forecasts have changed.
As inflation continues to soar and the increase in cost of living hits households nationwide, a recession does seem inevitable. So what is a recession? A recession is generally thought of as large-scale job losses, fiscal measures, and panic. When broken down simply, all a recession is 2 consecutive months of contracting growth within an economy, and this is measured by GDP. GDP, or Gross Domestic Product, is defined by the Bank of England as a measure of size and health of a country's economy over a period of time. Data on this is commonly published quarterly, so if you've got 2 quarters, consecutive quarters, of negative growth or contraction, that would suggest that the country is in a recession. Basically, it's the monetary value of all of the goods and all of the services sold within a country during a particular period of time. We would usually expect GDP in a growing country to go up steadily over time by 0.1, 0.2%, or maybe more every single quarter. However, as I've already said, when we have 2 consecutive quarters of shrinking growth, so a negative percentage growth, meaning that we've contracted our economy, that would signify a recession. Recessions can be caused due to a number of different factors, some of which include rising or high interest rates, we've got that at the moment, a stock market crash, falling housing prices, not really at the moment, and stagnant wages or reduced income in real terms, and that's something that we've definitely got. If you've looked at the news over the last few months, it's all been about the impending rise of interest rates both within the United States and within the United Kingdom. Now, the UK have raised its base rate to 1.75%, and America are going even further, suggesting that at their next meeting they may rise the base rate by 0.75 to 1%. Now, if it is raised by 1%, that is the highest single quarterly raise that has ever been experienced. This shows quite how seriously the US are taking the inflation at the moment, so they are really trying to do everything they can to stop it and calm it down. In the UK, interest rates are largely governed by the Bank of England and their base rate. In March of 2020, and to combat the coronavirus pandemic, the Bank of England lowered its base rate to 0.1%, the lowest it has ever been. Since then, it's been raised to 0.25% in December 21, 0.5% in February of this year, then been raised from 1% to 1.25% this June, and very recently it's been increased to 1.75%. This is all with the Bank of England suggesting that it could further increase to 2% by the end of 2022. While this is positive news for all of those savers out there, for people with mortgages and loans, it could impact the amount that you're having to repay every single month, further exacerbating the cost of living crisis that we're all feeling at the moment. Wages and earnings in real terms is also a hot topic, with a number of different industries planning industrial and strike action in the coming months, due to the fact of the rising cost of living, inflation, and the fact that that is, in real terms, reducing people's take-home pay. With UK inflation currently at 9.4%, wage increases would have to be greater than that to increase real wages. And this is clearly not going to happen for the masses. In fact, wage increases to equal the current rate of inflation have been actively discouraged to try to prevent a wage price spiral from occurring. This is where an increase in company wages would mean that the company would have to raise the prices and the cost of their products, which would mean that people would then need a further raise. And you can see over time that could be detrimental to the economy. It would seem then, while we're not in a recession at the moment, we are poised on the edge of one, with lots of different factors contributing to an ever-looming recession. It does feel inevitable in a sense, and any measure that we put into place now will probably be futile and not have the effect that's desired. For those of you who are into physics, we've essentially reached the event horizon. An event horizon is the term used for the point when a planet or something cannot escape a black hole, even if it's managed to somehow reach the speed of light. It will swirl round and round, slowly sinking into the black hole, like one of those penny machines that you'd probably have used to have seen outside Tesco. This definitely feels where we're at the moment, slowly going round and round, getting closer and closer to a recession until we fall into the black hole of recession. Anyway, enough of the astrophysics for the insane. This has all got me questioning, what will this recession do for the stock market, and what can I do and what can you do to help to make the best out of a bad situation? So how do stocks perform when faced with a recession? Investopedia states that during a recession, stock prices typically plummet. The markets can be volatile, with share prices experiencing wild swings. However, that is not the entire story. While news that the country is in a recession will likely cause the market to pull back initially, recessions aren't necessarily a black hole for the stock market, but it can feel a little bit like your Pac-Man with a spooky recession chasing you down. According to Forbes magazine, the S&P has surprisingly rose 1% on average during all recessions since 1945. That's because the market usually tops out before the start of recessions and bottoms out before their conclusion. In other words, the worst is over for the stock market before it is over for the rest of the economy. In almost every case, the S&P 500 has bottomed out 4 months before the end of the recession. Sam Stovall, the chief investment strategist for CFRA Research, suggests prices lead fundamentals. Therefore, the stock market falling into a decline is traditionally an indication that most investors believe we are headed for a recession. He goes on to say that when we do finally fall into a recession, that's usually a good time to get back into the market. In terms of how a recession can impact the stock market, here's where things get interesting. A report by Russell Investments suggests that of the 30 recessions between 1869 and 2018, 16 of them have resulted in a positive stock market return. These recessions with a positive stock market return have lasted an average of 16 months, with a return varying from 0.7% to 38.1% during that period of recession. These positive recessions averaged at 9.8% return, which, funnily enough, is just below the historic return of the S&P 500, which sits at 10.5%. So basically, over half of the documented 30 recessions have netted a positive rate of return, despite the GDP falling throughout that period of time. Next, I'm going to have to slightly correct the main man, Graham Stephan. When talking about a recession using the same Russell article here, he said,
now, to take this a step further, since 1869, one study found that the correlation between GDP growth and stock market returns was nearly zero at 0.05%.
This is incorrect. The 0.5% that he refers to isn't actually a percentage at all, and instead it's something called a correlation coefficient. Essentially, a correlation coefficient is a scale between -1 and +1, with 0 meaning absolutely no correlation whatsoever. Anything on the positive side, so anything above 0, would show a positive correlation of a varying strength, with a 1 meaning a perfect positive correlation. And the opposite is also true. Anything on the negative side, it shows a negative correlation, again with -1 showing a perfect negative correlation. In this case, as we're looking at periods of negative GDP, a 0.05 correlation coefficient suggests a negligible to very weak negative correlation. Now stick with me, essentially what this means is that as GDP falls throughout these recessions, statistically there's a correlation with the stock market going ever so slightly up. As I've said, arguably this is a negligible result to a very, very weak negative correlation. So in essence, the GDP movement and the stock market are not correlated really in any sense at all. This isn't to say that it's all rainbows and kittens. The average drawdown in a US recession is actually 30% from peak to trough. However, the data does suggest that by the end of the recession, the market actually comes out in a slightly more positive state than it was before the recession started. This all means that a recession can be one of the best times to invest your capital to make maximum profit. Buying in at those lows after the markets pulled back and then reaping the rewards of the recovery throughout the following 16 months on average. Something to bear in mind though is that it is difficult to know you're in a recession until it's too late, making the market extremely challenging to predict as ever. So what's the best course of action if we do fall into recession then, and how do we actually know if we're in one? In essence, it's pretty much the same as always. Continue to pound cost average into every single one of the investments that you would normally do, no matter whether it's up, down, whatever's going on, just stay consistent. You may not even know that we're in a recession until it's passed, and therefore if you stop paying in because you're waiting for a recession, you may just miss the boat. What it boils down to is no matter the economic condition or the state of the market, you should continue to make your monthly investments as you would do normally. Yes, during a recession, you may have a loss in earnings in real terms, making it difficult to continue to invest, but it's all about prioritizing what's most important to you. Yes, you may have to cut back a little bit on what you invest to pay your gas bills or your electric bills or for petrol. However, if you can stay consistent throughout that period of time, whilst it might be difficult, you will reap the rewards in the future. This really is a once or twice in a lifetime opportunity. Of course, through a recession, there are also worries about redundancy and job losses, so it's about making yourself as important and vital to your employer as possible, whilst also working on additional streams of income that you can continue to do no matter whether you're an employee or not. It's also a great idea to make sure that you've got an emergency fund saved somewhere away from your investments. And this should be able to cover 3 to 6 months of your normal bills and expenses, just in case the worst does happen and you have to dip into that to continue moving forward. Where should you invest your money, I hear you ask, throughout a recession? Well, consumer and healthcare have generally outperformed historically during periods of declining GDP. On the other hand, airlines, car manufacturers, hotels and casino stocks have struggled significantly throughout periods of declining GDP. Really, one of the best places that you can put your money throughout this period of time is in something like the VWRL, the Vanguard All World ETF, which covers massive geographical diversification and essentially enables you to hold the stock market. If you want more information on the VWRL, you can check out a video I've done previously just here. So you see, recessions don't have to be all that scary. If you play it right and stay consistent, you can make a lot of money throughout this period of time. While a recession does feel like it's chasing us down like poor Pac-Man, I think we've got this.